Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Torsten Slok of Apollo joins us now for more. Torsten, good morning, sir.
Morning.
We've got a few minutes to go over this one. What's your first take?
Well, a very important backdrop for this is that the framework the Fed uses for evaluating whether they should be hiking or cutting is the Taylor rule. And the Taylor rule has on the right-hand side two variables, namely unemployment and inflation. And both these components, namely wage inflation and unemployment, are actually pointing in the direction at least of the Fed staying on hold. Obviously, this is not enough for them to begin to hiking. But at the end of the day, the tailwinds to growth continues to be very strong. We have an AI and data center boom. We have strong defense spending. We have strong tailwinds also from the CHIPS Act, the Inflation Reduction Act. And we also still have relatively elevated stock price and home prices, all things that are supporting the U.S. consumer. And even before we then know what Trump will do and what he announced on the tax policy yesterday, if we do get lower taxes on Social Security, on overtime, on tips, other things, this would also be a tailwind to the outlook. So it's not clear at all that the Fed is done. And for now, I think it will be that they will be keeping them on hold. But the door is still open to hikes coming later this year.
Recent communication certainly suggests they'll be on hold. Implied in their outlook still, and their communication as well, is a bias to reduce interest rates. When you say there is a chance to hike, I understand from what we've heard from a lot of people on this programme, the bar to cut has got higher. But it's the bar to hike a whole lot higher. Just how low is that bar?
But think about it. Since the election, we have certainly seen animal spirits increase quite significantly. If you look at capex plans from the regional feds, they have all started to reaccelerate in the last 2 months. We've seen very strong improvements in a number of sentiment indicators, all pointing towards that there is still a chance that now there may be in the business sector in particular, the feeling that, well, maybe we should begin to hire more. Maybe we should begin to spend more in terms of capex. So it is still true where we sit today. The bar is high because the expectation is that inflation will continue to come down. But inflation today is still roughly at around 3%. So we're not near the target. And the trend in the last few months on a year-over-year basis has been up. So if you take both inflation and the labor market, in particular the unemployment rate falling and also wage growth as high as 4.1 on average hourly earnings, those are very important indicators for the Fed when they think about what they want to do.
A lot of independent indicators for wage growth don't show that same kind of heat. And as we heard from Mike Collins, some of this has to do with just the hours work coming down. And when you do the multiplication, that's what ends up happening, is that you see that kind of wage growth. I'm just wondering, are you seeing other signs of inflation picking back up other than eggs that really could be sustainable in an economy that otherwise seems increasingly concerned about disinflationary degrowth impacts?
So some of the indicators that have come in again since the election is ISM services prices paid have really jumped higher. You also see NFIB planning to raise average selling prices have also gone higher. And the home-based data, which is much higher frequency for the labor market, is also looking a lot hotter. So there are various indicators that certainly suggest that it's not clear that this narrative is that we are in a territory where monetary policy is very restrictive. If monetary policy was so restrictive, why is the unemployment rate going down? The unemployment rate should be going up. So in that sense, there's a lot of conversations around still. Is it really the case that we are in restrictive territory? In particular, again, with policies potentially coming not only on tariffs, but also potentially coming on restrictions on immigration, and also policies potentially coming in the last few days on tailwinds to fiscal policy.
If this is actually true, that the Fed could hike rates and that policy is not restrictive in any way, does it make sense to you that stocks would fall if benchmark rates stay the same, or the prospect of Fed rate cuts later this year is taken off the table?
Well, the main reason why stocks are falling, in my view, is that 40% of the index is the top 10 stocks that are really the Magnificent Seven. And they have such a big weight, and they are so sensitive in the risk parity models to what interest rates do. So if rates are now a bit higher and higher for longer, then, of course, the Magnificent Seven do tend to trend lower. So I think a very important answer to your question is that the Magnificent Seven and the tech companies make up such a big share of the index. So that's why we have seen some broadening out away from them. But the difference in performance between the tech stocks and the S&P 493 continues to be very important.
Torsten, you're talking about these tailwinds potentially from the policy in Washington, D.C., but how much do you think Trump is willing to expand the deficit?
Well, the Committee for Responsible Federal Budget scored what came out yesterday and found that it would increase spending by 5 to 11 trillion over the next decade. So in some sense, it all depends on exactly what comes through, and we will over the next 6 months have a lot of budget discussions, including culminating with the debt ceiling in June. So let's see where it all goes in terms of what the ultimate fiscal impulse will be. But it's clear that at least what came out yesterday did not point in the direction of fiscal consolidation, but pointed in aggregate in the direction of tailwinds to growth.
Let's talk about where we are right now. If you are just joining us, 12 minutes ago, the jobs report came in with a downside surprise on the headline number, 143 against an estimate of 175 on non-farm payrolls, but an upside surprise on average hourly earnings month over month, coming in at 0.5%, the estimate 0.3. Unemployment dropping back to 4% from 4.1. The estimate was also 4.1%. So that unemployment scare of the summer is over, dead and buried. The Federal Reserve, of course, was a little bit nervous about that and delivered 100 basis points of rate cuts across a number of meetings to close out last year. Now we're firmly on pause. We were talking a lot about the revisions for 2024. The average monthly gain has been revised to 166 from 186. And I think there were some economists who were looking for something a lot weaker than that.
Which is the reason why people are looking at this and saying, wait a second, we were expecting last year to have even less strength, and actually it was pretty strong. It just goes to undermine the fear that we had at the end of last year that caused those rate cuts by the Federal Reserve, and raises questions. Is this really a market that's so susceptible to cracks forming if there is a policy that hangs out there that creates a good deal of uncertainty?
Jeff Rosenberg of BlackRock joins us now for more. Jeff, you've had about 13 minutes to pore over these numbers. What's your big take, sir?
Jonathan, I think the big take here is January is a difficult month. There's a lot of moving parts. This is a mixed report. I think the conclusion remains the same. There's a very strong labor market. It's not going to change the Fed outlook. But probably the most interesting thing is the last thing that you said, that may be what the market is keyed on, which is the annual benchmark revisions. The market having expected a lot bigger validation of the story that the labor market is overstated in terms of payrolls. And the overstatement was not as overstated as people thought, and so maybe that's pushing up a little bit on the rate reaction. But overall, it's a mixed report. AHE, as Mike Collins and you guys highlighted, that's probably flattered by the reduction in the work week. The unemployment rate ticking down. That's on the strong side, and the payroll headline is a little bit disappointing, especially given the seasonal expectation that would give it a seasonal boost. Overall, I think you talked about in the earlier session about the asymmetry to the Fed. It's going to take a very, very strong report, and unlikely to come out of the labor report, but really an inflation report to push the Fed off of the cutting expectations. Whereas a weakening side, the Fed's going to be very quick to cut. I don't think this changes the outlook. We're still on pause here well through the first half of the year, and a lot more data is going to be necessary for the Fed to accelerate their pace of cutting, because they were very clear in highlighting in the FOMC they're in no hurry to cut.
Jeff, you talk about the asymmetry in the Fed's reaction function and their propensity to cut rather than hike if there is a weakening rather than some sort of boon. Is there an asymmetry in investors that needs to be rethought? That people really believed that this was an economy that was starting to show weakness, which justified some of the rate cuts that we saw at the end of last year, that maybe that didn't really exist. Maybe that we actually had a much stronger labor market than people had expected, and this is a market that is more susceptible to overheating than some people gave it credence over the past few weeks.
Yeah, that's the change. We had the fear on the labor market late summer, fall last year. That's been replaced by a debate. You started to get into it earlier around, really, are we that tight given how strong these labor markets are? And maybe the Fed doesn't have to move as far, and maybe neutral's a lot higher than we thought it was because of the performance, the strength in the labor markets, the strength in the economy, and the halting progress that we're making on disinflation. That's kind of the summation of the change that has really pushed us away from the Fed is going to push us into recession, the big increases in interest rates, much more towards what I keep saying on this program. The Fed's ignoring the role of financial conditions, an incredible wealth creation coming out of that Mag 7, AI wealth creation, wealth effect that is leading to much looser financial conditions than you would expect given the interest rate structure. And that's really, I think, the issue here, is that financial conditions haven't been transmitting into the real economy as tight of policy as the rate piece. And the Fed, in comparisons to the Taylor rule and interest rates, are just missing the boat here, that in a modern economy, really the post-GFC economy, it's financial conditions through which monetary policy transmits, not so much the interest rate. We're much less interest rate sensitive. We're much more confidence and spending sensitive, and that's driven by financial conditions.
So, Jeff, all of that said, when you put it together, would you fade the rally that we've seen over the past 4 weeks in the 10-year Treasury yield?
Well, it's interesting. You talk about the 10-year Treasury yield rally, and here we're talking about kind of before Fed and Fed policy. And obviously there's a disconnect here between talking about the rates on the short end, what the Fed is going to control, what the markets are going to react to with respect to the Fed, and what's going on the long end. And what's going on the long end is going to be much more affected by things like term premium, inflation uncertainty and inflation risk premium, and the fiscal policy outlook. So I think that we've gotten to a level of term premium that is normalized part way. You've gotten a lot better in terms of the term premium, and that's raised the attractiveness in terms of the 10-year relative to the 2-year. I think that fading it is not really the outlook right here. I think what you're going to be looking for is the debate around the next policy. A lot of focus on trade and tariffs. We're going to turn that focus into taxes and fiscal, and that's going to weigh a lot on where that 10-year and that term premium settles.
And that's how you dance around a pointed question. Jeff Rosenberg there of BlackRock. Jeff, appreciate it, sir. Thank you very much. Following the payrolls report about 20 minutes ago, downside surprise on the headlines number, but a much hotter than expected wage print. Let's turn to tech. The latest earnings from Amazon delivering better than expected earnings but giving disappointing guidance for the current quarter. The CEO Andy Jassy warning growth will be lumpy due to hardware delays and power constraints. Schweta Khajuria of Wolfe Research rating the stock outperform with a 270 price target. Schweta joins us now for more. Welcome to the program. First question, what we just heard from Amazon, how much of that was in line with what we'd heard from other players, the likes of Microsoft, for instance?
Well, thanks for having me. I would say the parts that were similar from at Amazon from Andy Jassy to Microsoft and Google and Meta was around CapEx and cloud. So what we heard from Andy Jassy were two things. One is that these CapEx investments, where they guided to over $100 billion in CapEx for 2025, they are leaning into what they believe there is demand for, and they would not be spending this money if they did not know that there was demand coming, because you procure all these infrastructure and data centers only if there is demand. And we have heard that time and time again from Google Cloud, from Sundar, as well as at Microsoft. That was part one. Two was his comment around and his reaction to what happened with DeepSeek and their R1 model. And the commonality here is basically the same thing that we heard from Zuckerberg at Meta as well as Sundar at Google around if costs of training and inference go down, the intuition is that the demand for AI will likely expand. It will expand the TAM because there will be so many more uses that will be attractive around applications to drive AI compute. And against that, all these companies are leaning into CapEx spend.
Schweta, so many analysts after these earnings came out pointed out time and again, this is still a behemoth. They're going to do very well. Mm-hmm. We don't understand why people are punishing them. And yet 4 out of 6 of the magnificent 7 that have reported so far have been meted with a really disappointing response in markets. How much do you think that ultimately this is investors saying we are worried about valuations and we're not going to extend things further, period, even though there is still that same promise of cloud computing?
I think it is more of that. I mean, if we look at valuations now, all the AI levered names have done so well over the past 2 years, where very limited upside for multiples in Meta or in Google, given that they also have the search overhang, or even Amazon. Of the mega cap names that we cover, I think that Amazon has the best valuation on a growth adjusted basis, but it is more of that against the fundamentals. I think that there's a common belief that AI demand and AI is going nowhere, but given where the multiples are, perhaps we would have to see greater upward revisions on earnings before they get more credit on the share price.
Just to sort of underscore this point, Schweta, do you think that this is more an issue of just simply people jittery about valuations and maybe even the flow of money due to other considerations, and less about DeepSeek and a feeling that you really can do it with less?
I think so. I think that the knee-jerk reaction with DeepSeek and R1 model was that this is negative for the mega cap names, at least within internet. I'm going to refrain myself from talking about the impact on NVIDIA, but for the mega caps within our coverage. But as more commentary came out from all the CEOs, it is becoming increasingly clear that perhaps there is demand that is more to come. And all these companies are looking at R1 model under a microscope and will figure out a way to lower costs. So I think that is established that costs will likely come down for training and for inference, and against that there will be demand. I guess the question is, we now need to see accelerated path to returns on these investments, and until we see that, estimates likely won't go up, and until then they may not get full credit.
Schweta, appreciate it. Good to catch up with you. Schweta Khajuria there.
Thanks to
of
have
Wolfe
me.
Research. Thank you. The Treasury Secretary Scott Bessent making the case for passing President Trump's tax bill and making the 2017 tax cuts permanent. Terry Haines of Pangaea writing, should the tax bill go to plan, it likely convinces markets to fuel US economic exceptionalism for longer and with more fervour. Terry joins us now for more. Terry, welcome to the programme, buddy. It's good to see you, as always. We caught up with Kim Wallace of 22V Research about an hour ago, actually, who made the case that he'd be surprised to see a tax bill pass before December, and this might become a 2026 story. Are you on the same timeline?
No, not at all, John. And good morning to everybody. Not at all, because what they've got to do is they've got to pass this thing in the first calendar year. They know that. I've got the tax bill at 80% likely to happen. The reason why is you've got a Congress that knows it needs a signature accomplishment, and you've got a president that wants things. Look, what you'll hear from Washington tax boffins now is all process related and kind of third level stuff. But Bessent will give you the clue here. What they want to do is preserve United States economic exceptionalism in the markets, absolutely, for as long as possible. They need a tax bill for geopolitics to keep America strong. They need a strong economic policy to buoy the domestic economy and to make America strong abroad. All that stuff. And by the way, they've got to get rid of a world where debt service is the biggest expenditure. So because that imperils all of the stuff that I just mentioned. You've got a president that's interested in doing big things. This is a time for big things. This isn't a time for small ball.
So is this a time for one big bill or two? I'm sorry, this is a minutia of Washington, but I think it does matter, because this is going to be incredibly hard, one or two bills, to make sure that this Republican Congress signs off on it, given, Terry, how slim their majority is.
Well, it matters some, Anne-Marie, sure. I'm not going to say to you the process doesn't matter at all. Of course it matters some. What I am suggesting, though, is that you shouldn't be diverted. No one should be diverted by process as if it's the main thing. And one bill, two bill, they get this thing done. You might recall back in 2017, the Congress faffed around with doing health care for the first 4 months of the year, and then only switched relatively late into the tax bill. That's not going to happen this year. They're all about economy. But what I would suggest is that the answer to the process question is anything that helps achieve those big goals that I just mentioned is what the process is going to end up being. Beyond that, though, it's minimal. The people that are in favor of one big bill, by and large, are people who are afraid to cross Trump. But if what ends up happening is that two bills provide a quicker start to all this, then he's going to be for that too, and he said so.
Terry, the president has talked about a lot of policies, tax policies he would like to see. Yesterday, we got carried interest loophole added to the list, which took everyone by surprise. You and I both know that for decades, Washington has been trying to close this loophole, and they failed. Why is all of a sudden this a Trump policy?
Well, I thought you all summarized this very well the other in the last hour. It's by and large political. It's certainly not a revenue raiser. I mean, there's one source that I've seen recently that estimated it raising something like $12 billion over 10 years. So it's a rounding error in the bigger picture. But you're absolutely right that it puts him on a kind of a populist political path. And if it doesn't happen in the end, well, it doesn't happen in the end. But that's not a frontline issue here.
In the meantime, we got the review from the Committee for a Responsible Federal Budget for the potential bill. It isn't great. It isn't great for that wonderful 10-year yield that Scott Bessent looks at. They said that it would boost interest costs by about $1.3 trillion over the next decade, exceeding $250 billion per year by 2035. Terry, how feasible is it that this Congress has the capacity to pass this bill and not just totally upend the bond market?
Well, here's a perfect example of what I mean by process, Lisa. Everybody's kind of focusing on the existing rules, assuming this is exactly like 2017. It's not at all like 2017, in part for the reason you mentioned. There's a much less tolerance for extending debt and deficit than there was in 2017, and you had a relatively weak president and a relatively strong institutionalized Senate back in 2017. The biggest debate that's happening right now isn't popping up in Washington conversations to markets very much at all, which is whether you'll use current policy as the baseline or current law as the baseline. Use current law as the baseline, then you're into what Maya McGinney's group talks about there. But if you change into current policy, then you become much freer to actually make the tax cuts a whole lot bigger and actually free up a lot more on what your pay-fors are and your spending are. I think I know which way this is going, and it's not going back with the small ball the way it used to be. It's going to the new baseline.
Which, Terry, raises the question of whether will it be allowed by this Congress. And some people point to the fact that you've actually seen quite a bit of unity when it comes to confirming some of the nominees, a surprising degree to some people. Do you think that is just playing nice ahead of the hardball that's expected around the budget, or do you think this is setting a precedent for what's to come, that there will be that unity?
I think there's still going to be a good deal of unity, and I think the Senate particularly has done a very good job of defending itself against Trump demands. You'll remember back in November, Trump was blustering on about how he wanted his nominees confirmed immediately, and well, guess what? We're still confirming nominees. That a lot of this stuff is being done fairly quietly, but at root, people that are talking about maintaining the current institutional rules around the tax bill in particular are essentially saying that the Senate parliamentarian is going to be more powerful than the President of the United States and a majority of senators and the will of lots and lots of the American people and probably markets. So I think I got, unfortunately for the Senate parliamentarian, I think I'm taking the other side.
Terry, appreciate it. Well framed. Terry Haines there of Pangaea Policy.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.